Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate a consistent return year on year. So the first thing we need to do is open up our brokerage platform. The one I like to use is Tasty Trade, however you can use whatever you like. And of course, we are going to be writing or selling these contracts. So we need to know where we are in the overall option cycle. Now, the market is closed. This is a Saturday. But by all means, we can just still take a look and mock up some positions. So if you come over to the trade tab, you just want to have any underlying open. We've just got UAL open. We've got a position on UAL currently, but it's fine. It doesn't matter. And you'll see two types of expirations, weeklies and also monthlies. So we want to be on the monthly expirations as opposed to the weekly expirations. And also we want to be somewhere between 30 and 60 days out in time. 45 would be ideal, but we'd have to see what we can get. So we've got October 18th, which is the next available, 6 days away, which is far too close. So we're going to go to the next one, which is November 15th, 34 days out in time. That's okay. It is a little bit on the short side, but the next one down from there would be December 20th, 69 days out in time, and that would be then too far at that point. So we're going to go with the November 15th, 34 days out in time. Now we've got this information, 34 days, we can come over to our watch list. You can have any watch list open, it doesn't matter what it is, and you just want to filter out any underlying that has earnings over the next 34 days. And the reason for this is because earnings will have a negative effect on your P&L. It will, and the reason for that is because it will increase volatility or vega. It will mess up your deltas, and all of these things are going to have a negative effect on your P&L basically. You also want to filter out everything that has a low liquidity level. You only want 3 and 4 star liquidity stuff. Obviously, if you're using a different broker, this might look different to you, but every broker is probably fairly similar. Just filter out earnings and filter out anything that's not very liquid. What's left is a list of things that doesn't have earnings, very liquid, and all that's left to do at this point is just filter everything from high IVR to low IVR. The reason for this is we want to only write contracts in high IV environments because we want to play the contraction. We want volatility to decrease, so that the value of the contract, the premium on the contract decreases, so that we can buy it back at a lower price than what we sold it for initially, and that's how we profit. So as you can see here at the top of the list, we've got CCEP, JCI, BK. Let's have a look at BK. We've not actually had a look at BK before. It's currently trading at $73, well, just under $74. It's got an IV rank of 67.9. It's not that correlated to the SPY. It's got a correlation factor of 0.57. It's got an IV of 25.9, and this is also another thing you want to keep in mind. IVR and IV are two different things. So a high IVR is great, but you also want to make sure that the IV itself is also good. For example, you know, Tesla and Coca-Cola can both have an IV rank of 50, but what that 50 rank is going to translate into raw IV is going to be completely different because Tesla and Coca-Cola move completely different to each other. So that's something to keep in mind. So, and just to double down on that point, as we can see here, BK with an IV rank of 67.9 puts it at an IV of 25.9%. But below that, Dollar Tree has got an IV rank of 62.6, but that gives it an IV of 50.4, right? So, and they're trading at around similar prices. So if we were to mock up positions, we'd probably get, well, we would get more premium out of a Dollar Tree position as opposed to BK. So I'm glad we spotted that. It's a very important point to note. And in that case, I think we will just have a look at Dollar Tree. So if you go over to Dollar Tree, we can open up the November 15th expiration as we've already discussed. And we are now presented with the options chain. So this orange horizontal bar shows you where price currently is with respect to the strikes. And this vertical orange bar shows you what the expected move is of Dollar Tree over the next 34 days. Now, we don't have too many strikes to choose from, so we may have to squeeze delta where we can, well, wherever, it depends on what the market gives us. So let's have a look here on the call side. We want to be anywhere between a 15 and 20 delta. Might be a bit difficult, but we seem to be in luck here. On the call side, we've got a 16 delta at the 80 strike, which is perfect for us. And on the put side, again, perfect. We're in luck. We've got a 16 delta on the put side at the 60 strike. This is actually a really nice and clean position. At the 60 and 80 strikes. It's worked out quite well. And if you notice, our contracts are outside of the expected move. And what this is going to lead to is a very nice and high probability of profit. And we can see that here down below on the left, we've got a probability of profit of 74%. And if we wanted to only take 50% of max profit on this position, then we've got a 90% chance of hitting that 50% mark at some point over the next 34 days. So as you can see, these are some very, very high probabilities, especially for when it comes to trading. So what does this look like on a chart? How can we visualize this? So if we go into the Dollar Tree chart, we need to mark price levels out at our contracts strikes, which are at 60 and 80. So if we just do that now at 60 and 80. So as we can see here, this is the range that we've essentially created for ourselves. And what we want to happen in this situation is we want the price of Dollar Tree to stay within this range. Okay. And as long as it stays within this range, we'll be making money. And specifically, we want Dollar Tree to expire within this range. And when is it going to expire? 34 days out in time. So what does this actually look like in terms of numbers? Now, if the price of Dollar Tree was to be within this range at expiration, then we will keep 100% of the premium that we collect. And what is the premium that we collect? That is what this number is down here, $1.63 per share. There's 100 shares per contract, so that is a max profit of $163. As soon as this order gets filled, we will collect the $163 upfront, and nobody can take that away from us. Our broker is going to require just under 1.2k in buying power to open this position. Now, this is a very nice return on capital for a naked position. Naked position meaning that we've not bought any contracts to cover the contracts that we're selling. We've not gone long on anything to cover our shorts, basically, hence why it's naked. And that's why we also have a max loss potential, unlimited max loss potential. And that's also why our broker requires 1.2k. This is to cover our back in the worst 5% of cases. And we'd also get just under $7 of daily theta decay. So if Dollar Tree stays within 60 and $80 at expiration, then we keep all $163. If you want to get out at some point, if you want to get out at the 50% mark, let's say we were to get out at say $80, then we've got a 90% chance of getting out at $80, taking $80 profit off the table at some point over the next 34 days, which is, it's crazy high, and your actual win rate will be higher than this because implied volatility is always overstated, or pretty much always overstated. That's our edge. That's the edge that we're playing out here. So that's basically Dollar Tree. That's what the position looks like. That's the numbers. Now, if 1.2k was a little bit too heavy for you, completely understandable. You can simply just buy another contract a little bit further out. So let's say you just go to the next strike down, $5 wide. You buy that contract. You do the same on the put side. Go $5 out, buy that contract. And now what you've basically done is created a $5 wide spread on either side. So you limited your loss by buying the contract further out. So your max loss is whatever the distance is between your short and long strike. So between 80 and 85, that's $5. That's your max risk. Between 60 and 55, it's $5. $5 is your max risk. Now you would collect 89 cents up front. So you take, and nobody can take that away from you, remember. So you take your $5 max risk, you minus off the $89 in premium that you collect. So $500 minus $89 in premium, that gives you 411, and now we have a max loss of 411 as opposed to an unlimited max loss potential. And your broker knows that you because you don't have an unlimited max loss potential, it's only going to require whatever your max loss is in this case. So we can massively reduce our buying power requirement by covering our shorts. And this is how you can manipulate positions to fit inside your portfolio. Now, there is also one other thing you need to keep in mind, and that is the size of your positions, right? And this is why you need to know how to manipulate positions, because if your positions are too big, then eventually something's going to go wrong and it's not going to end well for you. So what we've done is we've got this position sizing template that's free for everybody to use. And the way it works is you simply enter in the size of your portfolio. Let's say if it was $10,000. Below that, you can then enter in what the current VIX level is. Let's say if it's 15.2, everything below will then be automatically calculated for you. And at this point, you simply just need to use this information to form the backbone of your portfolio. It will tell you how much buying power to allocate to undefined risk positions, defined risk positions, how much of your portfolio you should allocate to short premium strategies in general. And as long as you follow everything here, you'll be just fine. Like I say, it's free. If you want to get a copy of this, click the link in the description and then click on free position sizing template. It will take you to where you need to go. And if you want to learn in more depth and make trades with us and copy our positions and see what adjustments we're making and see everything from the inside out as opposed to from the outside in, by all means, again, click the link in the description, head on over to EDS Premium, get yourself signed up. Inside, you'll have access to our portfolios where you'll see all of our positions. You can copy them if you want. We post all of our adjustments in real time. By all means, feel free to copy or just use it for inspiration or learning. There is also a full course inside, so no prior knowledge is required. We'll teach you everything you need to know. And if you still get stuck, of course, it's a private community, so you can speak with myself directly. And there's also, you can speak with other like-minded individuals. There's a 100% money back guarantee. So once you've studied our full course and followed our trades for 6 months, after that, if you haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free. You've got nothing to lose. And right now it's £1 a month. The price will be increasing. However, once you're in, the price you pay is locked. As long as you don't cancel and rejoin later, you'll be fine. You don't have to worry about a higher price. So with that being said, I'll see you guys on the inside.